Hello, everyone, and welcome to Stablecoins Are Killing It, number 15. I'm your host, Lou Kerner with Just Stable. In addition to this show, we have message boards at juststable.com. So if you want to yap about stablecoins, go to juststable.com. We've got a great show for you today featuring Ganesh Viswanath-Natraj. Ganesh, welcome.
Hi, Lou. Thank you for inviting me. So I'm just putting up my slides.
Let me quickly introduce Alex as well. Our other guest, Alex Lipton.
Hello?
Yep.
Yeah.
I was just welcoming you. So Ganesh is going to start in just a moment, but Ganesh and Alex are each going to walk through presentations, or I think Alex is just going to talk extemporaneously for about 10 to 15 minutes. And that'll be about a half hour. And then the second half of the show, the second half hour, is Q&A with the audience. So I'll be asking some questions. If you have a question, feel free to put it in the chat function on Zoom. And if we pick your question, we'll bring you up as a panelist so you can ask the question yourself. And with that, I'd like to hand it off to Ganesh.
Well, thank you, Lou, and for inviting me to present this work in progress. So essentially, I'll be talking about DAI, one of the major stable coins, and the stabilizing mechanisms. Okay, so what's special about DAI? So it's the first decentralized stable coin.
And Ganesh, do you just want to quickly just give me your background as well?
Oh, sure. So I'm a researcher at Warwick Business School. And so, I research exchange rates and more recently stable coins. And really, I'm interested in kind of the properties of stable coins, like what mechanisms kind of drive the peg back toward one. And so what's special about DAI? So this obviously be very familiar with the audience. It's the first decentralized stablecoin, and it, in contrast to coins that are based on backed by reserves, they are backed by crypto collateral, typically Ethereum. And it has an interesting feature of having policy rates where you can control the rate on borrowing DAI as a way to control supply. And here I'll be talking about the stability rate and potentially other alternatives to peg stability. And so right now, this is a work in progress. So I'm working with a colleague of mine, Rahman, at Warwick Business School. And so we are obviously looking forward to any feedback that you have. So the steps in generating DAI. So here I'm thinking about an investor that has some amount of dollar wealth. They then convert that into a cryptocurrency, say Ethereum, and then they deposit that into a collateralized debt position. And from there, they can borrow a fraction of that as DAI tokens, which they can then invest in, say, Bitcoin or some other currency. And upon maturity of the investment, that once they want to redeem DAI tokens and withdraw collateral, that's essentially how they close their position. So it's a very unique way of creating a stable coin that's pegged to the dollar and yet is backed by crypto collateral. So a very important property of CDP is the leverage ratio, and that is the ratio of DAI borrowed to the total value of collateral. And so DAI has an inbuilt rule on its smart contracts where if the leverage ratio exceeds 2/3, the position is liquidated. So there's a penalty of liquidation, which is up to 15% of DAI borrowing. So it's quite a significant cost to liquidation. And so we find that if you look at this leverage ratio in periods of high volatility of collateral, you find that the leverage ratio is typically lower, which implies that investors are risk averse, right? So in periods when Ethereum is really volatile, investors will tend to borrow less DAI, and that's a lower leverage ratio. But a reason why I look at this leverage ratio distribution is because essentially a lot of the stability tools can influence the leverage ratio and so influence the supply of DAI in the secondary market. Okay, so now to the peg. So in the last year in particular, it really has been one directional, right? And this will obviously be very familiar with MakerDAO because they're essentially trying to stabilize the price of DAI. And these premiums can be explained by two factors. So the first factor is on the demand side, there is a DeFi lending boom, and DAI has been one of the big currencies that have been used in the DeFi lending sphere. And on the supply side, in periods when Ethereum crashes, then you have a liquidation event. And so you get a big supply disruption to DAI. So that's effectively like the leverage shifting to the left. And that reduction in supply drives peg prices up.
Hey, Ganesh,
Yes.
just going back to the last slide for a moment. Obviously, we're still in potentially the very early days of the DeFi lending boom. And because DAI broke the peg, and obviously there's a limited supply, is DAI used less than it otherwise would be? So that if they fix some of these things, the demand for DAI, at the peg would be huge.
So there is an excess demand for DAI. So essentially any stabilizing mechanisms need to get supply to catch up. And so I'll discuss a couple of things that could be done. Obviously, it's a difficult solution, and I'm sure that a lot of people working with MakerDAO are thinking of solutions as well. But yeah, so speaking to the demand factors, so compound, this is a bit of discussion in previous episodes of the show as well. And essentially this has resulted in a huge surge in savings on DAI, right? So you've got up to 700 million of loans in DAI based on today's data. And they're offering DAI savings of about 3%, so quite significant savings rates. And that really has been the predominant demand side factor in recent months. Now, on the supply side, so going back to this idea of leverage of the CDP, so the most recent liquidation event, or like significant liquidation event, was on March 12th this year when Ethereum crashed by 50%. So this meant a lot of CDPs would have violated the 2/3 leverage ratio, and they would have been liquidated. And so these liquidations basically cause a deleveraging of CDPs, and then that essentially shifts supply to the left and can cause DAI premiums. So this is essentially a supply side factor that can generate DAI premiums. And if we go quickly back to this DAI price, so in March, we see really large spikes, and that corresponds to the liquidation event. Okay, so now to stability mechanisms. So the main one that is in DAI's arsenal is the stability rate, which is essentially regulating the cost of borrowing DAI. And this is decided upon by a vote by MakerDAO holders. So it's a decentralized voting structure where holders of MakerDAO tokens can essentially vote on the stability rate. And we find that stability rates increased a lot in 2019, up to 20%. So this data is for the period of single collateral DAI. So this does not cover the multi-collateral DAI of this year. So we do see significant stability rate rises in 2019. And that is in part because there were discounts in 2019. So it was a way to combat discounts of the peg. So simple kind of regression analysis shows that DAI stability rates does have price effects in the sign we expect. So an increase in the stability rate reduces DAI borrowings and increases the DAI price. So we find a 1% increase in stability rate leads to about a 20 to 60 basis point increase in the DAI price. So if the DAI stability rate works, what could be a potential problem? So in the previous figure, we saw DAI stability rates going up a lot in response to peg discounts. The problem is that in the reverse case, you need to, if you have peg premiums, you need to lower the DAI stability rate to get back to the peg. But the problem is DAI stability rates are bounded at 0. And so you have a situation where you would like to decrease rates below 0 to get back to the peg of 1, but you're bounded at 0. So it's kind of the 0 lower bound problem that is very familiar to macroeconomists when studying constraints of monetary policy. So this is quite interesting because we have actually a case where stability rates are really low and we have DAI premiums.
But is there, Ganesh, is there any reason why they couldn't have negative interest rates?
So that's a good question. So I don't know. So I think if there are negative rates, then that would be a cost to the Make a DAO organization, because now they would have to pay people to deposit Ethereum collateral. So there could be an issue where the burden of the cost burden falls on the essentially the Make a DAO organization who regulate the smart contract. So that could be one reason why they resist a negative rate. But in theory, yes, negative rates would definitely get the peg back toward 1.
Okay.
So savings rates is something DAI have been looking at, particularly in the last year since multiple collateral DAI started. Now, the problem is that you already have Compound and these DeFi lending platforms, right? And so they already offer savings rates on DAI. So for DAI to have its own savings rate, to what extent is that dominated by these DeFi lending platforms? So I think there's a case of a blunt instrument here where you can change the DAI savings rate, but then it might not transmit to decline in the rate Compound offers. And so you get this case where you whatever savings rates that you put on DAI are essentially dominated by the lending by the savings rates of DeFi lending platforms. So multiple collateral DAIs, so this obviously has been around since November 2019. And as well as Ethereum collateral, there's now been a significant increase in using USDC, which is another stable coin, as collateral, and WBTC is synthetic Bitcoin. And so this is an interesting trend. So how could this be a solution? So very simply, if you move toward more stable collateral, then you can increase the leverage of your positions, right? So if we think that the reason you have a low leverage is to avoid the possibility of a liquidation event, then if you have really stable collateral, then you can essentially leverage up to the limit, because you know that it's very unlikely USDC will collapse because it's a stable coin. And so when you shift the leverage ratio to the right, you increase supply of DAI, and that puts downward pressure on the peg. So this is a very simplistic way of thinking about how a more stable collateral type can put downward pressure on the peg. And that is
familiar with, are you familiar with the Metacoin project in Rye?
No, what's it about?
It's super interesting. It's Amin Soleimani, you know, one of the smarter guys in crypto, and you know he basically understood what you just said. So he actually is creating something RAI, which is you know, really supposed to be a established currency that is the collateral for the stablecoin to create the metacoin.
Okay, so I'll look into that. Was Rye presented in a previous
Yes.
episode? Okay.
Yes, the guy running it, Stefan Ionescu,
Okay.
spoke. It was early. It was maybe, you know, like 4 or 5, something like that.
Right. I'll review that, but basically, it's essentially saying if you get collateral really stable, you can increase leverage and then increase supply of DAI, and that should put downward pressure. So the question is, at this stage, I mean, USDC collateral has jumped up, so investors are starting to diversify away from Ethereum collateral to USDC. So that's an interesting trend to follow, because if investors keep doing that, then that should help bring the peg back toward 1. Another solution. So this I've seen in discussions by sort of Make a DAO people, and basically the idea is to enforce a kind of hard peg where you can actually guarantee a 1-for-1 price between DAI and USDC. So this is interesting because my understanding is that this transfers the burden of adjustment to USDC's stabilizing mechanism. So now whatever upward pressure you had on the DAI peg now gets essentially transferred to USDC. And USDC is backed by dollar reserves. So the arbitrage mechanism is an investor can deposit dollars with the issuer, obtain USDC and sell it in the secondary market. And that arbitrage should push prices back toward 1. So this would work in theory. The kind of potential concern I have is that if we think about dollarization, which is what essentially this is, it typically is done when for very, very small countries that have absolutely no impact on the US monetary policy. Here, we have a different situation where DAI is quite large, like it's 600 million, USDC is 2 billion, but DAI is large enough to potentially cause a large burden of adjustment in USDC. So it's kind of an interesting case where if they do force a hard peg, that could put a lot of pressure on the USDC peg. And that's something that needs to be discussed if the solution is ever goes down. But those were all of the solutions I had. Obviously, there are many other people working with Make a DAO and trying to increase stability. But I think personally, the multi-collateral DAI is quite a nice solution because it's basically encouraging the use of more stable collateral. But I'll end there, and thank you for allowing me to present, and looking forward to your questions.
Okay, thanks a lot, Ganesh. So take back the screen here just for a moment. There you go. And so, Alex, now you're gonna have the floor and can talk about whatever you would like to talk about.
Thank you. Listen, I was so impressed by Ganesh's slide that I prepared mine as well in the meantime. So how can I will share my slides.
Yeah, if there's a green thing, there you go.
Yeah, I mean, can you see them? Now you should be able to see, right? Exactly. You see the screen, right? So stable and trade coins in retrospective and perspective. So this is for Lou Kerner's show, right? On the 17th of September, 2020. So my name is Alexander Lipton. I am CIO and a co-founder of Sila. I'm also a professor and Dean's Fellow at the Hebrew University of Jerusalem and a fellow at MIT. And in my previous life, I was the co-head of the Global Quantitative Group for Bank of America. And before that, I worked for another a few more banks and hedge funds, including Citadel. And prior to that, I was a full professor of mathematics at the University of Illinois and a consultant at the Los Alamos National Laboratory. So my specialty before I switched to finance was applied mathematics, fluid dynamics, thermonuclear fusion, and things like that. And as a quant, I worked on many, essentially all areas related to quantitative finance, derivatives, and things like that, both as a researcher and as a manager. And so I have a perspective on that. So we founded Sila in 2018 with a group of co-founders, Shamir Karkal of the Simple Bank fame, Angela Angelovska-Wilson, and Isaac Heinz. And the purpose of the exercise is to make money programmable, first in the United States and later on worldwide. So I will talk a little bit about my views on stable and TradeCoin. TradeCoin is something which my colleagues and I at MIT invented a few years back, and it sort of was emulated later on by Libra. So essentially, if you know what Libra does, so that's was you know what the TradeCoin is supposed to do. All right. So let me see how I can. Okay, so the thing is that I'm taking an Aristotelian view of the situation. So I think that money, you know, it has been introduced by convention as a substitute for need, and it's not natural, so to speak, but it is derived from law. And so from that perspective, in my mind, you know, the entire crypto experiment will only truly become global provided that it can resolve some of the important issues related to you know, regulations and things of that nature, right? And so then the other thing which is also quite important is from Nicolaus Erasmus, from his important treatise on which is called De Moneta, and it was published in the 14th century and articulated the importance of signaling in coins and things like that. And so that's something which we need to be able to emulate in our day and age through digital currencies. And finally, Nicolaus Copernicus in the 15th century wrote an important treatise on money, which is pretty much unknown because it was kind of his fame is solely related to his discovery of the fact that Earth rotates around the sun. But the truth of the matter is that he made some other very important observations when he was studying monetary theory, and in particular number 3 on this slide. So when new currency is issued, the old currency must be demonetized is the most important one. So that's something which all this kind of stablecoin projects, or at least most of the stablecoin projects, are not addressing properly, including this putative design for Libra, right? So that's something which we need to talk about a little bit because violating this law is very dangerous since it will introduce inflation and other undesirable consequences. So you can see some of my most recent musings on the subject in the book, which is going to appear in the very beginning of 2021. It's written in together with Adrian Tricani, who is the CEO of Metaca, a firm in Lausanne dealing with security of crypto keys and things of that nature. And it covers a broad canvas, a broad picture of cryptocurrency, blockchains, and various applications. Also, if you're interested in a more economic aspects of what we're thinking about, you can read for free this book, Building the New Economy. Now it's probably called Building the New Digital Economy, and it's published by MIT Press, and right now it's work in progress, so you can just download it from the website for free, as I mentioned. Right, and so before we decide what to do, what we want to do, we need to know what the money is being used for. And of course, we all know that it's medium of exchange, means of payment taxes, means of payment in general, store of value, unit of account, and something which I added on my own is that it's also a perpetual call option on acquiring goods and services and discharging one's obligations. So that's the broad aspects of money, and the purpose of what I want to talk about today is how it can be done in the electronic environment we all live in, right? So the kind of money by its very nature is unstable. So when we're talking about stable coins, we need to understand that it's a relative concept, right? So it's stable with respect to something, unless you kind of have patience, and we go back to this question when I discuss trade coins, so when we can discuss stability in a different fashion. But if we simply look at purchasing power of money, we will see that both when money was represented by tokens of value, specifically by denarius, for example, but it's common for the Austrian Groschel and any other sort of silver coin which stays around long enough to observe this curve, right? So in 250 years, the silver content of the Roman denarius went all the way to zero. So essentially, and you know, that had a lot of consequences, including the fact that the fighting force of Roman legions also pretty much reduced to zero, because they, from being a paid salaried force, they started to rely on bonuses, and of course with all the consequences, right? So I'm not going to go into the consequences of bankers being paid bonuses, right? So, but I mean, when Roman legionnaires were paid bonus kind of payment, consequences were quite unstable. So, you know, same actually happened in a much shorter period of time with the US dollar. So this shows, you know, the purchasing power of the dollar over a period of 100 years. And as you can see, it kind of has reduced by at least 90%. Right. So, and then the other observations which we have to bear in mind is that, you know, we are going on a journey of building a new banking system, decentralized finance and things of that nature. And why do we want to do this in the first place, right? So first and foremost, this is due to the fact that existing banking and payment systems are still working, but they are obsolete and they're not aligned with the modern requirement. And we have seen it many times, right? So even now, like, for example, when we look at, you know, the distribution of, you know, payments to people affected by COVID-19, right? All those checks, the very fact that we're sending checks to people, you know, tells it all. It says it all, right? So, you know, in many countries, checks are not known at all. So basically, it's a very, very elegant but completely obsolete tool. And the fact that it's being used speaks volumes, right? So, also, the other aspect, which is super important, right, is that the system as we know it is on its last legs. Even if it's not immediately obvious, but if you think about it, if you know how it actually operates, you will understand that this negative or very low positive interest rates is a death blow. It's really, it's very, very bad for the banking system at large. And, you know, just yesterday, the Federal Reserve Chairman Powell indicated that in the United States, rates will still stay low for at least the next 3 years. In my mind, it would be more like 5 years probably, and even longer. And in Japan, it has been like that for 20 years, right? So it's quite bad, right? So, and one of the issues is why it's not, you know, why is banking system at large is not progressing as much as we would like it to progress. By and large, it's due to the fact that internet protocols are not really applicable to money. So there are no successful open access protocols for money and identity. And as I mentioned, money goes hand in hand, if we take this Aristotelian view, with some regulation, and regulation goes hand in hand with identity one way or the other, right? And so we don't have this, and even though there were placeholders when the original internet protocols were designed, these were never filled. And so, in my mind, a regularly compliant, fiat-backed tokenized medium of exchange can help to fill this gap, That's what we're doing in particular, but many others as well. And you know, you can view the corresponding tokens as an electronic analog of cash, right, with all its pluses and minuses, of course. And you have to understand that wit recently observed that if cash were to be invented now, it would probably be abolished, right? So it would never be allowed in some sense. And this is true because, you know, cash has advantages, but it has also disadvantages, right? So, you know, kind of the last point which I want to make here is that if suitably, you know, if suitably adopted, it can also be used to build decentralized finance, a decentralized financial market infrastructure and things of that nature. So here are kind of two of my pet examples of, you know, how value was transferred in the old days. And so this is, of course, Ryo-Fei Japanese stone, which is in fact an analog version of Bitcoin, because if you know the story, you know, the value is associated with the stones which were cut on some remote islands and brought to this island of Yap, 2,000 miles easily on a canoe. Of course, it's an expensive operation and very dangerous as well. So proof of work is there just in bringing the stone to the island. And then it's being mentally divided into shares. And the elders keep, you know, track and repeat it once a month or so, assigning shares to different parties. And of course, you don't use it to pay for coffee, the same way as you don't use Bitcoin to pay for coffee, in spite of whatever people were promising. It's not the case, right? So you only use Bitcoin for large transactions, which have sort of some symbolic importance, right? So same here, right? So it's kind of for marriages and stuff like that. So that's one example. And the other very interesting example, it's kind of, which was particularly, you know, prevalent in medieval England, but also all over Europe, right? So tally sticks. So that's another example of how money can be abstracted and sort of expressed in terms of, you know, this type of devices, right? And so now from this very elegant but probably obsolete solution, I don't think that we can really use stone currency, even though, as we will see, collateralized stable coins are pretty much like this Japanese stone currency, pretty much the same, right? With electronic overlay, of course. So one thing is to use central bank issued digital currencies or cash, right? So this is a very, very hot topic, right? So it's being kind of actually being done by the Bank of China. It's being actively discussed by many other players, including the Riksbank in Stockholm. By the way, Sweden is traditionally a pioneer in digital innovation. So it's one of the few nations in the world where essentially cash is already not known, right? So, and abolished pretty much, right? So CBDC, you know, kind of has various advantages, right? It's open way to better monetary policy. And by better, I don't necessarily mean better in a conventional sense of the word, but more efficient, right? So if central bankers really decide that they want to have seriously negative interest rates, like what Lou and Ganesh were discussing, right? So with paper currency can't really do much, right? So the kind of for decades, people thought that there is a zero interest threshold, so that interest cannot be negative. That was very naive. I have to say, I was arguing against this for a couple of decades because I knew history, and in history, negative interest rates were not unknown, mostly in the form of demurrage in the medieval Europe, but in some other forms as well. But the point is that, you know, there is a lower bound associated with cash. If indeed a central bank tries to make interest rates -2, -3%, people will start accumulating the reserves in paper currency. Of course, it's not entirely sort of free because you need to store it, or you need to insure it, and all that type of thing. By my calculations, it's about 30 to 40 basis points. So essentially, the very kind of limit of what the modern economy can afford is maybe negative 50, negative 70 basis points, and that's what we observe in some countries like Switzerland, for example, or Denmark. But in general, no more than that. If we have cash abolished, then of course you can make it seriously negative, like minus 5%, for example, which would be a version of inflation kind of in reverse, so to speak, right? You know, kind of, there are, as I said, other positive aspects, increasing tax collection, fighting crime, and so on and so forth. But at the same time, there are negatives, right? So like excess control over ordinary citizens, and what kind of, you know, these are all kind of negatives which need to be resolved. We need to strike a balance between privacy and efficacy, and that's not something which is technical in nature or even economic in nature. It's legal in nature and has to be established by law, so to speak, by our elected representatives, right? So, and there are two possibilities of issuing this central bank digital cash. One is through directly opening account in central banks, which is, of course, a very, very unlikely possibility for a variety of reasons. And among those reasons are those people who know how these organizations operate. They're just small. They're very powerful, but small. I mean, small people-wise, and so, I mean, there are not enough people, and so on and so forth. So they cannot really solve know your customer, anti-money laundering, and all the types of things by themselves. So in all likelihood, it would be done through narrow banks. In other words, banks with the only type of asset being the central bank cash, or possibly also some short-term government paper, and they will be issuing this coin. So it would be an indirect kind of route. And it's entirely possible. The other thing is that it might not necessarily be done on a blockchain the way we know it. It might be done more along the Chaumian ideas of anonymous cash. So I have indicated for many years, like 5-6 years ago in a speech at the London at the University College London, that's the most likely route, and that's what it seems like the People's Bank of China is taking, right? Okay, so there are kind of CBDC is technically possible, but politically complicated, and there are several alternatives. One is the utility settlement coin, as you know, kind of as being developed by a group of banks and Clearmatics in particular. And by the way, in the interest of full disclosure, I'm a senior advisor for Clearmatics. So, but you know, that would be designed for banks alone. Right? So it's more like not the people's coin, but essentially a professional kind of token, which is used to exchange value among banks. And then stable coins, of course, are much more promising, you know, direction. And of course, as we were discussing, they have been proliferating massively recently and being used as a foundation of decentralized finance and things of that nature. And we should distinguish fully collateralized custodial tokens, tokens over collateralized with crypto. That's something what Ganesh was talking about, dynamically stabilized tokens and stuff like that. So essentially, I am a believer in fully collateralized tokens, but the thing is that, as I said, in order not to violate the third law of Copernicus, you really need to have a narrow bank issuing it. It's completely fool's gold to try and use collateral within the banking system itself to build a stable coin on top of it, even though it's being done right now. And, you know, Sila is currently doing it as well. But I mean, it's an intermediate stage for us, right? So we are solidly in the camp of having either a broker-dealer license, if it's granted, or some other means of keeping collateral in general, eventually, not right now, but eventually outside of the existing banking system. And there are several thing, you know, kind of a bigger project than ours right now. But our purpose is not to create a stable coin for the, you know, facilitation of trade in other cryptocurrencies, but rather as a tool for building programmable money for the real economy. So that's our emphasis. You can see what we're doing on our website. And then, you know, coins partially collateralized by fiat is a horrible idea. I don't even know why I left this slide, but I mean, I'm not going to talk about it. Now, crypto over collateralized coins, Ganesh provided a masterful description of those, so I will keep this outside. And then, you know, dynamically stabilized coins is a joke. I mean, it's not possible, right? So I'm not even gonna dwell on it much, but I mean, there were some huge hopes. But sure, you know, in general, what puzzles me very much when people are talking about the crypto economy, creating of this dynamically stabilized coins or automated market makers and stuff like that, it is as if decades of thinking about how things work were not did not exist, right? So it's like there is a complete you know, tabula rasa where you can write things, which is not exactly true, because the laws of supply and demand and laws of trading will never change regarding of what exactly you're trading. And so dynamically stabilizing a coin is just not possible, right? So asset-backed coins is a very, very interesting, exciting direction. And of course, it has a huge pedigree in the British thinkers of the 19th century, and then the Americans, and you know, of course, Keynes, and then Kaldor and others, Hayek. Many people thought about it. This is something which is what we have taken at heart at MIT and proposed this digital trade coin. You can read about it and a freely available paper published by the Transaction of the Royal Society, as well as a popular paper in Scientific American. And the idea is to use collateral in order to build trade coins, which will circulate within trade, you know, kind of unions, so to speak, right? Facilitating trades across borders and stuff like that. So this is an illustration from the Scientific American where you can use actual collateral and sort of do this. And so we thought about it at a sort of geopolitical level, at the level of New Silk Road and stuff like that, as well at the micro level, at the level of cooperatives of people who grow, I don't know, cocoa and stuff like that. And these are the thoughts which we have. And so they will be stabilized pretty much along the lines of what Ganesh was talking, but I think this type of stabilization is more meaningful because there is an actual collateral and you can see how the whole thing is stabilized. And the good thing about this digital trade coin is that they have a real value and the price representative of a basket of commodities. And it does have certain volatility with respect to fiat just because it's represented by a basket. In principle, this basket can be a basket of fiat currencies as well. And we can have a transactional currency, right? And so that would be a great facilitator of international trade. So this is a general picture how it can work. And there are possible variants, as I said, using fiat currencies, of which Libra is an example. And that is all I wanted to say. So I'm happy to answer questions after Ganesh is done. Thank you.
Okay, that was terrific, Alex. A lot of history in there. I'm going to start with the first few questions, and you know, wanted to see what your thoughts were on Tether. You know, for me, the most interesting thing in the 3+ years that I've been 24/7 crypto is that when Tether, which rose to acclaim because supposedly they had $1 in the bank for every tether that they issued, they only actually came out that only had 75 cents to the dollar, and and nobody cared. And so, do you think there's for me that was an eye opener about that this is all about nobody's buying it to turn it in for $1. Everybody's using it because they believe that the next guy is going to accept it for $1. And so it's all just a confidence game that is actually going to happen. And so I don't know if you had any thoughts on that.
Ganesh, do you want to take a stab at that?
Sure. Yeah, this question comes a lot, and obviously you would think that there would be a confidence crisis if if a statement saying that it's only 74 cents back to the dollar comes out, but the fact that there was no significant price response tells me that, yeah, the market, as you said, is still expecting the price of Tether to be 1. A subtle point with the 74% backing is that that claim is that it's 74% backed by cash or cash equivalents. So there could be a case where Tether is fully backed, as Tether claims, but they have some of their reserves in non-cash or cash equivalents, right? So there could be a kind of a definition where, because cash or cash equivalents is a very strict set of assets that have to be sufficiently liquid, if there's some interest-bearing assets on Tether's balance sheet that are not considered cash or cash equivalent, that can explain the discrepancy. But yeah, that's all I have to add to that. Obviously, Tether's audits or Tether's claims are that they're fully backed. And certainly when I worked on prior research on Tether, that's my working assumption.
My take on it is that, Lou, you're actually right. So it's basically based on the assumption that the next guy will take it for $1 and that sort of thing. And probably the truth of the matter is that 75 cents in the dollar is enough to avoid run on the Tether unless it becomes a total, right? So bear in mind that in a conventional fractional reserve banking setup, banks essentially keep maybe about 10% of the kind of stated deposits in liquid form. And, kind of banks are regulated kind of on two sides, right? So on the asset side, capital regulates the amount of assets a bank can have. And on the deposit side, the central bank cash and cash equivalents define how big a deposit base it can have. And so usually it is viewed like enough to have 10%, right, for a smooth operation of the banking system, right? So 75% is not small, but of course it's by no means what is stated. And I also don't know where the remaining 25% are, right? So besides, I would say Tether circulates within a narrow confines of the crypto universe, right? So it's being used by speculators who want to park, they say, Bitcoin profits for the time being, if they think that, they sell Bitcoin, and rather than moving money into the bank system, which might be very hard for an exchange, right? So in this regard, for example, the fact that Kraken yesterday got a bank license of sorts in Wyoming is actually it's quite a big change in the overall situation. But, given the nature of how Tether is being used, 75% might be okay until it's not okay, so to speak, right?
Yeah, everything works till it doesn't.
That's exactly right. That's how I view it.
Let me follow that up, and then we'll open it up to questions from the audience. And again, if you have a question and you're in the audience, please type it into the chat or the Q&A on Zoom. And that's, obviously you've got a far more storied background, thinking about money than I do. I really, I have an economics background, but and my mind has been blown kind of time and again by different things that I've seen in crypto that was just not how, I understood the world to be. And I was just wondering, if you'd had that experience as well, given, you'd spent a lot of time thinking about money before, the crypto came about.
Are you talking, Lou?
Yeah, I'm asking you, just in terms of,
Oh yeah, I mean, it's really, it's a journey down the rabbit hole, definitely, right?
Yes,
so
exactly.
the amount of truly strange creatures in the garden of crypto is mind-boggling. But my own take on it is that this happens because many people who are involved in this business are not really understanding in great detail what it is they are doing, right? So from that perspective,
sometimes I think that can be an advantage, right?
that is entirely possible. You know, like Napoleon.
You totally can't do.
Napoleon used to say that he does have a battle plan, you know, to show up and see what happens. And that's what it looks to me what these guys are doing. And, you know, for many years, he was the most successful general in the whole of Europe, right? So that strategy is not necessarily a bad one, but I mean, certainly some of the constructs, like for example, swaps, Uniswap, for instance, where you know you maintain a you know constant product of sort of the number of different units in the pool. On the face of it, looks like an object with negative convexity, and hence you will be losing money at every step of the way. And so, whether you know in you know this transaction cost which you gain out of this exercise sufficient to cover it, I doubt it very much, especially if there's sharp moves of the underlying. But you know that's an example.
When you say the negative convexity, you're saying that that's what we call slippage.
Yes, if you wish. So, and you know, the thing is that you know people come up with their own colorful language to describe what is going on, right? So, for example, impermanent loss, right? The very term implies that things will go back to the average and stuff like that. So essentially, what it is, it's a slightly modified version of the pairs trading, right? So in a conventional market, right? When you sell one stock and buy the other under the assumption that they should go together and so on and so forth. So if you can identify pairs where it's very likely, like for example, some of the Australian banking stocks, which are simultaneously traded in that's generally true. If you try generally to look at, you know, say two oil companies and sort of think that they will move in unison, that might be happening for a while and then disappear. Same story with this AMMs and stuff like that. And so, yeah.
I'm going to have another question, but I don't know if Ganesh wanted to answer that question as well about kind of your mind being blown in the time that you've been.
I mean, personally, I feel it's very interesting space. You know, to study exchange rates, study exchange rate regimes, and then kind of see how these stable coins work. I mean, personally, I think DAI has been very interesting experiment. Obviously, for me, it was fun to study these things because it's kind of putting a lot of tools that we've seen in other finance contexts and then kind of as a new application. So it's been interesting to learn, and Ampleforth is also a very interesting experiment as well. So personally, it's been interesting to study this.
Yeah, I didn't get the sense that Alex would be impressed with Ampleforth.
Yeah,
very true. Yes, I mean, yeah, I know what it is, right? So yes, I wouldn't, yeah. But it's interesting. Look, I mean, the thing is, it's definitely interesting. The other thing, whether it works, right? So.
Yeah, well, I mean, to hear them talk about it, it's right. I mean, the way I look at Bitcoin is that it, you know, it set out to be peer-to-peer cash. It had a set of properties that ultimately didn't enable it to be peer-to-peer cash, but it turns out that with those properties, it's an amazing store of value, you know, in my belief. And so Ampleforth has these unique, attributes, and the question is, you know, can those play a role in, you know, this new ecosystem? And let me ask if either one of you, because I think the most interesting thing, you know, I've been 6 months kind of spending the vast majority of my time on stablecoins. And again, seeing a lot of super interesting things. But the most interesting thing I think that I've seen, and I've just been digging into it over the last number of days, is stable credit. I don't know if either one of you have had a chance. That's Yearns. You know, and among other things, I mean, they're basically forging together this idea of stablecoin and AMM and, you know, lending, debt, you know, in kind of one single-sided, and they have a single-sided AMM, interestingly, which actually solves potentially some of the problems I think you were talking about around slippage and impermanent loss. You know, and anyways, it is, you know, and on top of everything from my perspective too, you know, my background is the second company I ran was the world's largest social network, so called Bolt. And so when I saw crypto, I became of the belief that community is important, and Yearn stable credit is the first stable coin that also I think has a real community behind it. You know, and I think, you know, some of the other stable coins like Sila, I think, you know, that are trying to make the world a better place, which, you know, have communities as well. But I think Yearn stable credit has a unique one. Let me have finally, you know, I think we have time just for one quick question from the audience. We've got a question from Lori. And so Lori, you're now a panelist and you can ask the question yourself, Lori. You've got to turn your camera on and your...
Thank you. Thank you, Ganesh and Alex, for your very interesting presentation. My question is for Ganesh. Do you think if the DAI savings rate was adjusted by an algorithm and are adjusted more often, that it would be easier to hold the peg?
Yeah, this is interesting. So I guess your question can apply to the stability rate as well. So both the savings and the borrowing rate. But I mean, right now they have this decentralized voting structure where holders of the MakerDAO token can vote on a change to the DAI savings rate or the DAI stability rate. And they need to get enough votes to beat the previous vote for there to be a change. But an algorithm could, I guess, effectively do these adjustments autonomously without needing a vote. I'm sure that yeah, so there are pros and cons. I mean, it would increase the frequency of adjustment. So the moment, say, you're at a discount, you increase the DAI stability rate, you're at a premium, you lower it. So that could be done automatically. Of course, like with Ampleforth and with algorithmic currencies, even if you can fine tune the algorithm, there could still be problems with investors adjusting their behavior. And so so in some sense, it's like a moving target. Like you have an algorithm that should get you to the target, but then people's behavior changes. And so now you have to change the algorithm again. And so then it gets kind of like you can run into this dynamic instability problems that Alex was talking about. But yeah, for sure, it's an alternative to a vote. I mean, obviously the vote has some advantages because it's kind of a community adjustment rather than an algorithm that people might disagree with. So there's some advantages to the vote over an algorithm.
Okay, thank you.
Thanks for the question, Lori, and Ganesh. Thanks for the for the answer. And with that, we're at the top of the hour. So thanks everybody who showed up. Ganesh and Alex, thanks. I thought it was a super interesting show. And we'll see you next week on Stablecoins Are Killing It.
Goodbye, ladies and gentlemen. Goodbye.
Thank you. Bye.